So we are going to be testing one of the more popular indicators out there, and we're going to be using that indicator with a trading strategy that I found on YouTube to see whether this particular trading strategy is either cap or not cap. Let's have a look. What's going on? My name is Dillon. Welcome back to the channel. Now, in today's video, we are going to be testing the highly popular Donchian channel, and we're going to be testing that indicator on a trading strategy that I did find by Critical Trading on YouTube to see whether that particular trading strategy works or doesn't work through a quantitative approach. So what are the questions we are trying to answer, and what is the methodology that we'll be using to validate this particular trading strategy? Well, the first question I had after watching Critical Trading's video was the sample size. Now, when looking at the sample size, he only used 4 ETFs or 3 futures to actually test this particular trading strategy. And of course, when it comes to quantitative trading, you would probably know that sample size is very, very important. I want to actually validate whether the trading strategy works not only on those 4 assets, but on a much wider range of assets and different instruments. The next question I had, and you'll see later on, is this is a long only strategy. I do want to assess whether this trading strategy does perform on not only longs but to shorts as well, so we are going to be answering that question too. Now, the next question I had is I wanted to see whether we can optimize this trading strategy and make any minor tweaks or changes to see if we can extract a bit more money out of the markets. Now, a lot of you that do follow my channel, of course, I've talked about no nonsense Forex before, so a lot of you are probably Forex traders, so I'm going to see whether this trading strategy works in a completely different market, and that is Forex. So in terms of methodology, I'm not actually going to be doing too much optimization. I'm only going to be doing very, very minor tweaks, if any. And so I don't think that we do need to do the whole quantitative approach. We need to test in sample, out of sample. Of course, ideally, it's probably a good thing to do, especially if you are making tweaks. The whole purpose of this video is to actually validate and test a trading strategy that is already out there and already used, just to see whether it actually works or doesn't work. So in terms of actually testing and validating this trading strategy in terms of methodology, I'm actually going to be using the same test period that was used by Critical Trading. So because we're using the same time period, the variables in terms of time is exactly the same. So we shouldn't really see too many discrepancies, if any. So that way we can actually check whether the trading strategy that I have prepared actually works and is actually producing the same results as Critical Trading. And that will give our baseline and our base case scenario. And then we can start making some minor tweaks, for example, adding the longs and shorts, or maybe doing some minor adjustments here and there to see whether our adjustments is actually more profitable than the base case scenario. So I hope that makes sense. This particular trading strategy is one that I was super excited to go and test out, and I'm super excited to be sharing with you. So without further ado, let's actually go and check out this particular trading strategy. So this is the trading strategy that we are going to be assessing today. Again, this was from Critical Trading. I highly recommend going to check out this video. It is one of his most popular videos on his channel, so I highly recommend going to check that one out, particularly if you want to get a better understanding of what this trading strategy is trying to do. However, of course, the whole idea of this particular series is we can't take anything for granted. We do want to make sure that we are testing these strategies, whichever strategies that we do find on the internet, to make sure that they do work. Now, as I mentioned, I like to take a quantitative approach to trading, and that's exactly what we're going to be doing today. As you can see, this is the Donchian channel. If you're not familiar with the Donchian channel, basically it just plots the highest high and the lowest low over a number of days, and it plots it on a graph. It looks similar to a Bollinger Band. It's one of those band type indicators, but that's the Donchian channel. Again, if you don't really know what it does, I do highly recommend that you go and check out some other resources. Check out Critical Trading's video or some other resources that you do find on the internet. There's plenty of documentation for you to get up to speed with the Donchian channel. Now, we are using a 200 simple moving average, which you can see here. This is this yellow line here. That's a 200 SMA, pretty familiar. I'm sure everyone will know about that. And that's all the indicators that we need for this particular trading strategy. It just uses 2 indicators. It's a very simple, basic trading strategy, but it might be one that actually works. So the whole idea is this is a long only trading strategy, which can be used on a number of markets. And basically the entry point for this particular trading strategy, we can see one example here. We've got a buy signal. It enters on the next candle, and that buy signal happens based on two criteria. The first criteria is that price has to be above the 200 simple moving average. If price is above the yellow line, which is the 200 simple moving average, we can look for long trades. The second criteria is we need to get a close below the previous Donchian channel. So we can see that here that the Donchian channel previously was this line here, and we can see that price on the next candle has opened. It actually gapped down. It gapped down, and then it did confirm a close, which is lower than the previous Donchian channel value, which was this. So because there was a close below the previous Donchian channel, which is this is where we would go long. Now the Donchian channel can be used in a multiple different ways. It can be used as a breakout trend following type strategy. However, for this particular trading strategy, we are going to be using the Donchian channel as a kind of like a mean reversion or a pullback type of strategy, where we're currently in a long regime, which the long regime is of course price being above the 200 simple moving average, and there is a close below the Donchian channel. So there is a minor trend down in the price. We think that the price is going to follow the overall trend, and the overall trend of course is that 200 period moving average. We think it's going to revert back to the mean, and we think it's going to follow the overall price, so we're going to go long. So this is again a mean reversion slash pullback type of trade. Now of course, when we enter a trade, we need to have appropriate money management, and when calculating the position size or the money management, we are going to be using the ATR, and we are going to be using 2 times the ATR to be setting our stop loss, and the ATR is the average true range. If you've been following my channel, you of course would know what this indicator is. However, saying that, if you aren't familiar with this particular indicator, then I recommend of course watching Critical Trading's video. He gives a very detailed definition of this. So we're going to be using 2 times the ATR to set our stop loss, and we are going to be risking 5% risk per trade of our account every time we put on a trade, and that's the exact same parameters that Critical Trading was using when utilizing it for futures trading. So we're going to be using 2 times the ATR at 5% risk of our account. And so with the particular code that I've done, you can see this stop loss over here in red. That's the stop loss that we will be using. So of course, we've got our entry point, we've got our money management, we of course finally need an exit, and that exit is going to be a crossover of the upper channel and a close above the previous upper channel. So the opposite conditions of when we entered, where we're looking for a close above the upper band, like for this example here. So these are the results from the base case scenario, and these are the results from the same trading strategy that Critical Trading was using. Now, one thing that I do want to mention is that we're using the money management that Critical Trading used when he was looking at the futures. If you've watched the video, the futures were at the end. So we're using 5% risk per trade of our account capital at a stop loss level of 2 times the ATR range. Now, one thing that I just want to mention is that leverage might be an issue. The only reason why I'm mentioning this is because with ETFs, you might not have access to leverage. So if leverage is a problem, then you might need to consider that, of course, especially if you are expanding your portfolio. However, just one thing to mention is that we are using 5% risk per trade of our account, and 5% in my opinion is very high. So if we do lower our 5% to say something like that was 2%, we are actually lowering the amount of ETFs that we are buying. So therefore we may not need to incorporate any leverage at all. And I think adjusting our money management techniques is something that we are going to have to do and touch on later on. So just one thing to note for now, leverage. So as I mentioned, we are using these 4 ETFs, and these are the same 4 ETFs that was used on Critical Trading's video, and this will build the base case for our trading system. And we can see here for this example, we actually have a trading strategy that makes 33% each year. Now 33% on average each year, that is insane. Just with a very basic strategy, that's just crazy, using this money management on these particular ETFs. However, as I mentioned, because it is so high, it does raise a couple of eyebrows, and that is the sample size. So of course we have only tested this on 4 different ETFs, and because we're only testing this on 4 different ETFs, ETFs, we can see that the sample size is only 368 trades, and that is, in my opinion, relatively low. Now, when it comes to quantitative trading, sample size is actually very, very important, because the bigger the sample size, the more confidence you have in that particular trading strategy. And this is where, as I mentioned, I did have one question, and that is the lower sample size. Can we really trust these results? How can we increase the sample size? And the way we're going to be doing that is, of course, increasing the amount of pairs that we are testing, or the amount of assets that we are testing. Now, 33%, that might look very, very promising. However, if I do scroll across, we can see that our actual drawdown happened to be minus 18,000. Now, I am using a $50,000 account. So 18,000 from 50,000, that actually gives us a maximum drawdown of 37%. So 37% was our maximum drawdown at some point in time, and we can see that value here. Now, 37% is above the threshold of most traders. Most traders like to keep their drawdown between 10 and 20%. And the reason why that is so high, this 37%, is because we are using a 5% risk per trade. As I mentioned before, 5% risk per trade is very, very high. So we might need to adjust that down and optimize that a little bit later. So I just want to show the equity curve of this particular trading strategy, and it is a very, very nice equity curve. However, although it looks nice and there is very few drawdown periods, as mentioned, there was a 37% drawdown period. And if I go to the next tab, we can see that that particular drawdown period was over here. It was $18,000 for this particular drawdown period, and it actually happened twice near each other. So I also want to look at the average drawdown, and the average drawdown for this particular trading strategy was 8%. So the average drawdown was not actually too bad. 8% of the account is actually really good. So we can see that these 37% were probably a little bit more of outliers, but of course that's on average, and that average drawdown is reduced even more because it is a profitable trading strategy and it is making new highs. So that's good to see. All in all, pretty good trading strategy, but we do, of course, have those questions and we do need to answer them. So sample size, as I mentioned, that was very, very important. And to increase the sample size, or to increase the amount of trades that we are using for our testing purposes, I have increased the amount of assets for this particular trading strategy when doing this back test. We can see here that the top 4 values are the same as the ones that we used before, but I have now increased the sample size to 22 different pairs, which we can see on the screen here. So these 22 assets are based off the US stock market that tries to encompass a broad range of different markets within the stock market. So we're trying to minimize correlation there as much as possible. It also incorporates other commodities and other treasury notes as well. So of course, we've also kept the trading strategy system the same. I haven't adjusted anything. The entry and the exit conditions are the same, as well as the money management. We are still risking 5% on each and every trade we are doing, whilst having the same stop loss level at 2 times ATR. So straight off the bat, we can see here that we have increased our number of trades from 300 to now 1700, which is about a 5x, which is really, really good to see. We have increased the sample size here. Of course, probably more would be a bit better. So of course, do your own DD and try to test as many either ETFs or actually stocks, individual stocks. Try to test as much as possible to increase that sample size so you can validate this trading strategy. Now, the blatantly obvious one that I do want to address is this 119% return that we do have for this particular trading strategy. Now, first thing that I want to mention about the 119% is that it is profitable. The actual end profit has actually increased from what I think it was 200,000 to now 800,000. Again, we're starting off with a $50,000 account. So on average, over 14 years, which is our testing period, we can expect to return 119% each and every year with this trading strategy. There is one condition, however, and I want to mention this and I want to demonstrate this because you really need to understand what you're doing in terms of back testing and looking at metrics, because the main reason why this went up or increased, because this particular trading strategy is very profitable on a lot of other pairs or assets that we have used. So that's of course a good thing. But the other thing why this has increased so much is because we have extended the amount of assets that we are trading from 4 assets to now 22 assets without changing the money management at all. all. We are still risking 5% on each individual asset when we are trading. So because we have increased the amount of pairs that we can be trading, we should be minimizing the percentage risk per trade from 5% to something much lower, because we are increasing the amount of pairs that we are trading. So I just want to show here that, of course, if you've been watching my videos, we need to look at not only the profits but the losses as well. And we can see for this particular example that increasing the amount of pairs that we are trading, or the amount of assets that we are trading, our expected drawdown is also going to increase too if we don't adjust our money management. And we can see here for this particular example, we've got a 203% maximum drawdown. So 203% means that we've lost double our account. So we've not only lost $50,000, which was our initial starting balance, but we've also then lost again another $50,000. So then we owe money, and that's just crazy. And that's why money management is so important, and why understanding all of this is very, very important, and why I wanted to show this with you today. Because if you're blindly just adding in more pairs that you will be frequently trading, you've increased from 4 pairs to now 22 pairs without adjusting your money management, you might be over leveraged. And then if you get one bad day, you can lose a lot of money, and you might be in a very bad drawdown period. And that's why money management is so important, and why really you should be testing and understanding these things thoroughly. So if you're familiar with this spreadsheet and you've been following along, what I'm going to do is actually adjust my drawdown to 37%, which was the same drawdown that was in the base case scenario. And we are going to be using a 37% maximum drawdown for our tolerance. I'm going to hit calculate. So that actually calculates our adjusted risk per trade. So instead of using 5%, we're using something that is less than 5%, so that way it's tailored to a 37% drawdown. So now we have adjusted our risk tolerance, and we are using the same drawdown, which is 37%. So now we can actually compare the profitability appropriately, so that way there is no inherent bias. We can see how this trading strategy performs. Now, with this adjustment, we can see our profitability is now 22%. Now, it's good to see that this is, of course, profitable. However, before we were in the 30s, we have now dropped to 22%. We do have some pretty poor performing assets here, and this is in the commodity space here. We've got sugar, we've got natural gas, we've got US oil, and it's not really doing the best here. More or less, it's done well in our ETFs up here, and we can see that's where majority of the performance is. So from that case, we can really confirm that this particular trading strategy does very well when it comes to stocks. So we have tried to use a diverse range of different ETF stocks, so that way it encapsulates different markets. However, of course, as we do know, the stock market has generally gone up, so that's why this particular trading strategy does well. It is a long only strategy, and it's really suited for the stock market. We can see here that we've also got US Treasury notes down the bottom here, and it has performed well with the TIP as well as the TLT, of course, that we tested before, but it hasn't really performed in some of these other ones as well. However, saying that, it might be good to have a little bit of diversification so you're not all in on stocks. So the last thing that I want to show you is just this number over here, and that is our risk adjustment. So when doing this calculation, I have adjusted our risk based on a 37% maximum allowable drawdown. So this now gives us a maximum risk per trade of, we can probably round that to 1. So let's say 1 or 1%. Now this is really good, because remember before we were risking 5% risk per trade, and if we were to risk 5% risk per trade, we would see a drawdown of 200%. Now, if we were to reduce this to say 1% risk per trade, we would see probably around about a 37% maximum drawdown of our account. So that is really good. That 0.9 or that 1% is now our newly adjusted risk per trade. So if you were to go out and you were to trade this particular trading strategy with 22 different pairs or different assets, we would need to lower our risks to about 1% instead of 5%, because if we were over risking, we're risking 5%, we will eventually blow up our account and we will see that 200% drawdown. And that is why you cannot just simply add on more pairs and trade all of the pairs without adjusting your risk. You do need to adjust your risk. Money management is very, very important. So we can see that we have ticked off the first question, and that was increasing our sample size, and to actually validate whether there is some statistical significance here and whether we can actually validate that this trading strategy is profitable by increasing the sample size. And we can say, yes, it is profitable. It is about that 22 to 30% range. So it's actually a really, really good strategy, particularly for one that is very simple to use, and it's primarily more profitable in stocks. However, saying that, can we improve on it and can we make it a little bit better? And that's exactly what I am trying to do now. So what I've got up at the moment is a drawdown period for this particular example on the Vanguard ETF, which happens to be the real estate ETF VNQ. And this is a drawdown period that we did see for this particular trading strategy. So we really need to understand what is happening in the drawdown period, and we need to try to prevent these drawdown periods because of course we win by not losing in this example. So is there anything that we can add, any other parameters or conditions that we can add to this trading strategy to make it a little bit better? So we can see here for this example, we've got a drawdown period which has had consecutive losses, about 4 losses in a row in a very, very small amount of time. And we can see here that our actual trading strategy is executing quite well. We're still in an uptrend. We're still taking long positions in an uptrend. However, we are hitting our stop loss very, very quickly. And that is because we are in a minor downtrend where we are trying to buy the dip and trying to look for a mean reversion or a trend back up. However, it's not giving it to us and we are trending down, more or less trending down all the way to the 200 moving average, where we are then hitting our stop loss again and we are not actually trading in this particular period. So how can we improve this, and how can we put in a condition where we don't actually take trades when we are actually in this particular downtrend? Now, something that I came up with is actually looking at the slope of the lower band of the Donchian channel. Donchian channel. So if I zoom in here, we can see that the Donchian channel is sloping down. It's consistently making new lower lows and it is consistently buying these lower lows. See, we got another buy signal here, hits the stop loss, and then we enter in again straight away because it is, of course, following the conditions. We are, of course, buying the breakout, or we are buying the close when it does close below the previous Donchian channel low here. And we are buying this, of course. Our trading strategy is actually working how it's meant to. However, it's not actually working the best because of this particular market regime. If the Donchian channel is making new lows, then we are, of course, in a downtrend, and it's a bigger downtrend than simply just buying the dip and hoping for a mean reversion. So one condition that I want to add in is to make sure that we are not actually buying when the Donchian channel is actually sloping low. I want to be buying the Donchian channel when it is actually in an uptrend. So I want to be putting a condition in where the Donchian channel isn't making a lower low and then a buy on that next lower low. So for this example here, we can see that the Donchian channel is flat or it's making a new high here. So it's actually sloping upwards. I want to only be buying in these scenarios. So if there is a breakout of this candle, for example, here, I would only be buying that. Again, I would also only be buying when it's flat. So even if it's in a downtrend, I want to be buying if it's flat, and this might be an example here. It does flatten out a little bit here. I want to be buying that as well, but I don't want to be buying when there's continuous lower lows being done, because that is clearly evident of a heavy down trend. So I'm going to be putting in that condition, only buying when the Donchian channel is flat or it is actually sloping upwards, not when it is sloping down like this. This is a clear heavy downtrend. So these are the results for the adjusted trading strategy, and this is where things get a little bit interesting. So again, we're using very similar conditions. We are only buying when the Donchian channel is above 200, simple moving average. We are also only buying when there is a close below the previous Donchian channel low, and we are adding a new condition where we're assessing the slope of the Donchian channel, where we're only buying if the Donchian channel is either flat or in an upwards trend. We are not buying when the Donchian channel slope is sloping down, because that might be indicative of a very heavy downtrend. So these are the results. Now, again, these are the results using a 5% risk per trade, and we can see that our total trades have reduced, and that is because we have incorporated another filter to our trades. We can see, however, that our profitability has gone down, and that was from 114, I think it was, to now 104. So it has gone down about 10% from memory. And again, this is using 5% risk per trade. However, the important thing here is that our drawdown has actually gone down a significant amount. So if I highlight this one, before this one was about 200%, if you recall that, it's now gone down to 140% using 5% risk per trade. Now, again, we are using 5% risk per trade, which is not helpful. We're still losing our whole account, but it has gone down a significant amount. So if you understand the metrics, we've reduced our profitability by 10%, but we've also reduced our maximum drawdown by 60%. And that is a big difference. And that means that our trading strategy in terms of profit factor has increased. Now, as mentioned, a good way to measure the success is to standardize the drawdown. So again, what I'm going to do is actually do 37% maximum drawdown allowance. And then that is going to recalculate the risk per trade, but also recalculate the profit factor as well. And we can see the results there. And these are the results for our trading strategy. We can still see that our trading strategy is profitable here. Over 14 years with a $50,000 account, we've actually produced 4 times the amount of profit. Now, this is not including our initial principal of $50,000 account. So at the end of 14 years, we'd profit $200,000, or our total balance at the end is about $250,000. So we've actually 5x'd our account in 14 years. And one thing to note is that this is not compounded. Now, again, coming on the side, we can see here that we've got a maximum drawdown of 37. Well, you can't see that. We've got a maximum drawdown of 37%. Our win-loss ratio is 60% over here. And that 37%, of course, is adjusted. We are adjusting our risk per trade. And we can see this calculation over here that the optimal risk per trade is now 1.33%. So remember, before that was about 0.9. It's now increased to 1.33%. And that is because we are reducing our maximum drawdown by a significant amount. Now, over here, we can see that the expected return each and every year is 27%. Now, remember that this is not compounded, and the value over here is not compounded. With a non-compounded trading strategy, we can expect to 5x our account in just 14 years. However, with a compounded trading strategy, just for fun, I've put this here. With a compounded trading strategy, after 14 years, this trading strategy would have returned $1.5 million. $1.5 million with a $50,000 account. That's not bad. So with that minor tweak, you are reducing the amount of drawdown that you have for your trading strategy. So that means that you can risk a little bit more risk per trade, increasing your profits. Of course, none of this is financial advice. When I say your, I mean mine. So the last thing that I just want to show you is the equity curve for this particular trading strategy. Now, this equity curve is the non-adjusted equity curve for the trading strategy. So the equity curve that still risks 5%. However, if we are reducing the risk, the equity curve will actually look exactly the same as this. Just the numbers on the left-hand side will actually be different. However, saying that, looking at the equity curve just from a visual basis, we can see that the equity curve is very nice. It actually performed very well here, and that was the tail end of the GFC coming out of it, where the markets did, of course, do particularly very well. And we can see, of course, that it has done well since then, because Jerome has got his printer on and he's printing all of these tendies for us. So this particular trading strategy in a long only scenario for stocks has, of course, performed well, but has performed extremely well compared to the actual traditional stock market, particularly when making these adjustments. So we've answered 2 of the 3 questions, and now up to the 3rd question that I had, and that is whether we can add in a short regime as well. So we're not only looking at longs, but we are looking at shorts too. Now, for these short conditions, we are doing the exact same thing, however, in reverse. Now, we have the same 3 conditions, however, flip the other way. The first being, of course, is the price has to be below the 200 simple moving average for shorts instead of above the 200 for longs. So we're looking at price being below. The second condition is that the close has to be above the upper band of the Donchian channel. So we can see over here that price actually closed above the previous Donchian channel high, which is here. So we've got a cross above the Donchian channel. So price closed above here. We've confirmed the close. So we enter in short there. And then the third condition is the new condition that we added in. So before, we are only looking for trades where the Donchian channel was either flat or in an uptrend. For the short regime, we are looking for the Donchian upper to be flat or in a downtrend. So these are the results for our trading strategy, and we can see that we've got a profitable trading strategy still. We do have, however, $500,000. Now, if you recall before, we had about $700,000 with the long only trading strategy. Our actual profitability has dramatically decreased with this long and short regime. We have increased the number of trades that we are getting, of course, because now we are adding in an additional trade. We are looking at not only longs but shorts as well. So that should, in theory, of course, increase the amount of signals, so therefore increase the amount of trades that we do put on. Now we can see that this is very evident here. We can see that we do have a maximum drawdown of now 224%, and this is with the additional third rule that we have put in. So if you recall before, we went from about a 200% maximum drawdown to then 130% maximum drawdown when we incorporated that new rule. We've now gone back up to 224% maximum drawdown, even with that third rule when incorporating shorts as well. So this is now our adjusted risk parameters based on a 37% drawdown requirement. We can see here that our win-loss ratio has gone down. It was about 60%. It's now gone down to 56%. And so we can see here that if we look at our metrics, we can see that we went from about a 27% ROI, and now we have reduced that to about 13% ROI. So we've actually about halved the profitability of our trading strategy by incorporating short trades as well. So for those people that did have some high hopes that this trading strategy that would work for stocks would now work for different markets, particularly Forex, which is completely different. Hate to say it, I'm sorry, but it's a dud. So as we can see here, this trading strategy is negative. Now, this trading strategy is the same trading strategy that I previously tested, which is the three conditions for our entry signals, the same money management, the same exit conditions, but also longs and shorts. Now, I'm not going to be using a long only trading strategy, of course, for Forex, because it is completely different than the stock market. Now, the long only trading strategy worked really, really well, particularly for the stock market, as well as treasury note ETFs. However, I'm definitely not using long only for Forex. Of course, I can do the same thing, and I can adjust the parameters to 37% just to keep things consistent, and it is still minus $7,900 over 14 years. So this particular trading strategy is not profitable for Forex. And the reason why I wanted to highlight this, because not only one, a lot of people on my channel are Forex traders, because I, of course, mentioned that I cover no nonsense Forex. I also wanted to mention that you can't simply just take one trading strategy that performs well in one market and then slap it together and put it into another market without at least testing it. Trading strategies are useful for one market and maybe not the other market, particularly if it's a long only trading strategy. Even though I've added in the short regime as well, it still didn't perform, unfortunately, in the Forex market. And that is why you need to really do your DD and really understand what this trading strategy is trying to do and put that into the appropriate market. So of course, when it comes to this particular trading strategy, it is a dud for Forex. However, it is very, very promising for the stock market. So just for those people out there, this is the equity curve. What a dud. Drawdown. So that just goes to show, make sure you do your DD. Please do your DD. So there you have it, everybody. This is a very, very profitable trading strategy, particularly when doing those minor adjustments, which I did show, which I did come up with. I am pretty proud of myself, I have to admit. I think I actually made that myself, that slopey boy thing. I actually think I did come up with that myself, or maybe I'm just having a mental, a mind fart and I forgot actually if I got it from somewhere else. I don't know. I'm pretty sure I did. I'm going to take credit for that. If I stole it from someone, I am sorry. But anyway, so of course we've answered the 4 questions that we had. The first question was the sample size and whether it would work on a much larger sample size, or whether critical trading actually cherry picked those 4 ETFs. We confirmed that increasing to 22 different assets, we found that over those 22, it was in fact profitable. Now the second question was, can we actually increase the performance of the trading strategy? Which yes, we could. We did add a minor tweak to the trading strategy, and that helped reduce the drawdown. It did reduce the profitability just a little bit. It dramatically decreased our drawdown from our trading strategy. And when we are reducing our drawdown, that means we can increase our size. So if we're upping our size, we can then up our profitability. So that is really good, and that is good to see. And I'm glad we made that change, because we now have a trading strategy that makes 30% using 2 or 3 indicators. That's just crazy. Now the next one was adding in shorts. Now unfortunately, particularly with what we were using today, way adding in shorts just did not work. Now, this is a trading strategy that looks like it's optimized for the stock market and it's worked best for the stock market. I'm going to be keeping it as a long only trading strategy because when we added in the shorts, it didn't do too well. Now, the final question was, can we use this for Forex? And again, unfortunately, no. And that highlights the importance of making sure that you do test every single trading strategy that you do come up with or you do find on the internet. And even if it works on another market, it doesn't necessarily mean it's going to work on the other market as well. So you have to test everything. That is incredibly, incredibly important. Now, moving forward, if you've watched my previous videos on this channel, you would know that the next episode for this, I'm actually going to be going through the actual code of this. So if you do want to actually use this particular trading strategy and test it out for yourself, you can then watch the video that will be coming out in the future that will be actually going through the code. So that way you will have this particular trading strategy, and then therefore you can test this trading strategy using the same techniques, and not only test this trading strategy for the assets you want to trade it on, but also validate that everything I'm showing you actually works. Now, I think that is very, very valuable. And again, as I mentioned, the whole reason for this YouTube channel is not only to document my trading, but also to be helping those people that want to take a quantitative approach to trading, want to possibly pick up coding. And this is exactly why I have the whole coding series on my YouTube channel. So I have to say a super big congratulations and a thank you to Critical Trading for his video on this particular trading strategy. Now, I understand he got this from another trader from a book. I'll reference the book down below in the description. All saying that, go and watch Critical Trading's video. I have to say it is a very, very good video. So a lot of effort has gone into this video. Of course, it's been months, I wouldn't say months, but a few weeks in the making this Donchian channel video. I did want to, of course, give a little bit of value and provide a little bit of an optimization there and a little bit of a tweak for those people that watched this video. So with all that being said, I really appreciate you tuning in. I would really appreciate a comment down below, hitting that like button, and also, of course, smashing that subscribe button so that way you can stay up to date with not only my future video, which I run through the code, but future videos testing out other trading strategies to find which ones are cap and which ones are not cap, so that way we can all develop ourselves as traders. We can all separate the good trading strategies from the bad and do it in such a way that we are taking a quantitative approach to trading, because that's the approach that I do like to take. So thank you again. Super grateful that you could tune in today. I hope you have an amazing rest of your day. Happy trading, happy investing, and I will see you in the next one. 30%, man. Jeez.